In the previous accounting lecturer, we have seen three important concepts. Now, in this lecturer, we will be dealing with some of the 5 or 6 important assumptions or concepts which are important for the examinations. The first concept is money measurement concept. What is money measurement concept? The money measurement concept states that a business should only record an accounting transaction if it can be expressed in terms of money. That means if at all you can express it in terms of money, then and only you can account it or you can mention it in your accounting books. We can take an example. If at all you can, for any of your issue, if you call to the customer service of any of the company, okay, then you like the service that they are providing, okay, and it is also well known that due to this customer service their business is growing. But as this customer service is intangible, that is we are unable to touch it, but we can only feel it, okay, we can only feel it. So it can't be measured in terms of money. It can't be measured in terms of money. Therefore this cannot be accounted in the accounting books, okay, or it cannot be mentioned in accounting books. That is, business should only record a transaction. It should only record a transaction of an accounting if it can be measured or expressed in terms of money. That is nothing but money measurement concept. Examples of items that cannot be recorded as accounting transactions because they cannot be expressed in terms of money, such as, which include, first one, employee skill level. That means you can measure the quantitative amount of the measure, but you cannot measure the qualitative measures. The first example is employee skill level. You can't mention it in accounting. The second is employee working conditions. Third, expected resale value of patent. Fourth, value of an in-house brand. Product durability. The quality of customer support or field service. The efficiency of administrative process. Do remember all these things, as these cannot be mentioned in monetary terms, therefore they are not mentioned in accounting books. And any of these examples can be asked in the examination, and they tell you to identify which of them can be mentioned in accounting books, right? See, all of the preceding factors are indirectly reflected in financial results of a business. That is, it is indirectly reflected, but it is not directly reflected because it can't be mentioned in monetary terms, okay, but it can be mentioned in only the service, and it will reflect as an indirect in the financial results of a business, right? Next, this handout will be provided in the form of PDF to you in the Telegram channel. If you want to read it, you can join the Telegram channel and download the PDF files. The link will be provided in the description. Okay, the next concept is accounting period. What is accounting period? See, if at all I have started an organization, okay, if at all I have started an organization, then I have to measure its income, its profit and revenue, right? And I can't do it for a period until and unless my organization is running, okay. So in between I should measure the income as well as profit for me. So in order to do that, there is a period that I will mention in order to account it, and that is nothing but accounting period. This concept helps in estimating the profit or loss and financial position of a business for a particular period, that is from this May to the next May 2022. This is the accounting period for me, or it may vary for any of the organizations, but always or majoritarily it will be in the terms of financial year end, that is as per the government. Next, if there are different accounting periods, then various problems can arise. That is, for the first period I will do it for May to May, okay, and for the second period I will do it for April to April. Now there is a gap of 1 month, okay, and this will lead to the misinformation for me, okay, this will lead to the information that is not correct. Therefore, if at all there is a different accounting period, then the various problems can arise, like calculation of profits, comparability of various incomes and expenses, etc. Thus, to study the result of a business, if the life of a business is divided into short periods of equal length, that is, short period is nothing but 1 year. Okay, I am dividing this 1 year, sorry, this 10 years. If at all my organization is running for 10 years, then I am dividing it into 1 year plus 1 year, like this, for 10 years. Okay, then this division will lead to the accounting period for me. Each such period is known as accounting period. Okay, this is a simple definition of what is accounting period. Now we will go on to see the third important principle, that is full disclosure principle. What is full disclosure principle? The full disclosure principle states that all information should be included in an entity's financial statements. This is important. Each and every information that is measurable in terms of monetary is should be included in the entity's financial statement. That would affect a reader's understanding of those statements. Okay, see, if at all the accounting is done, then it is provided to the internal users as well as external users. We have seen who are internal users and who are external users in our previous videos. Okay, if at all you are mentioning, see, for a Reliance industry, if at all for Reliance industry, which has we can take an example, which has a net worth of 4,000 crores. Okay, and in the meantime they have spent 2,000 rupees on a machine for a repair. Okay, but this 2,000 in front of 4,000 crore doesn't matters, and therefore if at all they didn't mention it in their accounting book, then it does not affect the users who are reading this accounting books or who are taking the decisions on these accounting books, right? But if at all I am running an organization with a capital of only 10,000 rupees and I have spent 2,000 rupees on the 2,000 rupees on the machine for a repair, right? Now, for a capital of 10,000 rupees, 2k, that is 2,000, is a huge matter, and I should mention it in my accounting books because this will impact on the decisions that being taken by the internal as well as external users, right? The interpretation of this principle is highly judgmental since the amount of information can be provided is potentially massive. To reduce the amount of disclosure, it is customary to only disclose information about events that are likely to have a material impact on the entity's financial position or financial results. This the meaning is nothing but for Reliance, which has 4,000 crores of net capital, for whom 2,000 doesn't impact. Okay, and if at all they didn't mention it in accounting book, it doesn't matter, right? But if at all a capital of 10,000 rupees, 2,000 matters a lot, and if at all he didn't mention it in the accounting book, it will of course impact his business as well as the decision makers. Thus, full disclosure principle is nothing but all information should be included in an entity's financial statement. Just remember this simple sentence, that all, that is each and every information, should be included in an entity's financial statement which will be useful or which will have an impact on the decision makers. Several examples of full disclosure. We can see several examples of full disclosure are: first one, the nature and justification of a change in accounting principle, the nature of non-monetary transactions, the nature of relationship with a related party with which the business has significant transaction value, the amount of encumbered assets, the amount of material losses caused by the lower of cost or market rule, a description of any asset retirement obligations, the facts and circumstances causing goodwill impact. You can include this information in a variety of places in the financial statements, such as within the line in term of descriptions, in the income statement or balance sheet, or in the accompanying disclosures. The full disclosure concept is not usually followed for internally generated financial statements. It is not usually followed for internally generated financial statements where management may only want to read the bare bones financial statements. That means if at all the management just want to read those statements, then it will not be mentioned in accounting for internal purpose, but it will be just communicated orally, right? Hope you understood what exactly is the full disclosure principle. Next, the fourth important principle is materiality principle. Materiality is the threshold above which missing or incorrect information in financial statement is considered to have an impact on the decision making of users, right? As we explained for the above, Reliance, whose net worth is 2000 crore, right, for whom 2000 rupees doesn't matters, and if at all they didn't mention it in the accounting book, then also it does not impact the decision makers. Whereas for a capital of 10,000 rupees, if at all he didn't mention this 2000 rupees that he has spent on the machine, then it will have a huge impact on the decision making. That's why the material principle states that that is, it is the plus or minus level which missing or incorrect information in financial statement is considered to have an impact on the decision making of the users, right? Materiality in sometimes constitute in terms of net impact on reported profits or the percentage or dollar change in a specific line item in the financial statements. Examples of materiality are as follows. See, the materiality concept or principle is an accounting rule that dictates any transactions or items that significantly impact the financial statements should be accounted for using GAAP exclusively. What is GAAP? We have seen it in the previous lectures, right? If you haven't watched that video, please do watch it and try to understand. We have beautifully explained what is GAAP. In other words, if a transaction or event happened during the year that would affect how an investor would view the company, it must be accounted for using GAAP on the financial statements. If you want, you can read this example. Okay, next. The fifth and the final principle that we will be dealing in this lecture is prudence or conservatism principle. What is prudence? It is nothing but wise. That means a person is wise, or he is wise because he has understood that if at all he has taken care of now, then he can save it in the future. This is nothing but meaning of prudence. Now we will see what is the prudence or conservative principle. This principle states that you should not underestimate your revenue expenditure. Okay, you should not underestimate your revenue expenditure or capital expenditure. Okay, and also you should not overestimate your profit. This is nothing but prudence or conservative principle. See, the idea of conservatism suggests that you as a business should anticipate and record future losses rather than future gains. That means you should not guess that you are getting more profit in the future. You are going to get more profit in the future, but you should anticipate that I will be in loss in the near future, so that you, if at all you get more income, then you can create an asset for you. But if at all you get a loss, then also you can maintain, as you have not overestimated your profits. See, we can see it again. Definitions. The principle of conservatism in accounting gives guidance when recording cases of uncertainty or estimates. In other words, you should always lean towards the most conservative side of any transactions. You should always lean towards the most conservative side of any transaction. In situations where uncertainty exists and there is doubt between two reasonable alternatives for recording an item, according to the conservatism principle, your accountant should always choose the less favorable outcome. This could mean missing profits by recording estimated expenses or losses and not recording the estimated gains or revenues. If there is uncertainty about a loss or potential loss, then you should record it. This is important. If at all there is an uncertainty about a loss or potential loss, then you should record it. That means if at all there is a case running on you, okay, there has been a case running on you in the court and you don't know what may be the compensation amount, right? But it may occur in near future, therefore you should mention that in your account book that 10 lakh will be lost in future because you need to pay it in future, right? Then this is nothing but you are recording it because it is uncertain about a loss or potential loss. Next, if there is an uncertainty about a gain or potential gain, then you should not record it. That means in future, if at all 10 lakh compensation is being getting back to you, okay, getting back to you, then also you should not record it because there is an uncertainty that you are getting or not getting. Okay, but you have to record if at all you are going to pay it in future, or you may anticipate that you may pay in future. Then, and of course, if there is a certainty about a gain, then you should record it. That means if at all you are sure that, if at all you are sure that you are, of course, you are going to get the amount, then you can record it here. Okay, so this was the lecture that we need to cover, and these are some of the important principles or aspects that need to be covered, and there are many more principles that we will be covering in the future lecturers. So if at all you are new to the YouTube channel, please do subscribe the channel and press the bell icon for notification. If you haven't watched the previous videos, you can check the videos on the playlist. We have made separate playlist for all the subjects. Thanks.